In this video, I'm going to introduce the definition of GDP and discuss how GDP figures should be interpreted. What do they mean? GDP figures are extremely important because they are summary measures of economic performance of countries. Especially when it's in per capita terms, it gives us an idea how well off people are in one country versus others, or how well off people are in a particular year compared to previous years. GDP measures the total income earned by everyone living in a country. When you divide it by the population, it gives you per capita GDP. I'm going to also show you very soon that total income of a country is also equal to total expenditure on the goods and services produced in that country. First, a very concise and condensed definition of GDP. GDP is the market value of all goods and services produced in a country during a given period, usually a quarter or a year. Now, let's look at some details of this definition and what do they mean and how the outcome of GDP measurement should be interpreted. What does it really mean? GDP, as we said, is the market value of all goods and services produced during a given period. I should add that GDP is normally the value of all goods and services produced legally in the country. However, there are some illegal products that occasionally may be included in GDP, depending on the circumstances. For example, in the European Union, some activities are legal in some countries, but not so in some other countries. But the European Union wants to have a measure of GDP across countries that is comparable. So it requires all its members to collect data on all the goods and services that are considered legal in any of its members. One example of this is prostitution, which is legal in some countries but not in others. But all European Union countries collect data and try to include that activity in their measurement of GDP. Let us now focus on the aspect of the definition of GDP which focuses on during a given period. It's very important to keep in mind that GDP includes all goods and services produced currently during that period. Anything that is produced in the past and resold in that period doesn't count. Of course, the sales activity might be included if it's current production of a service, but the good itself has been included in GDP of a previous period and is not part of production activity in the current period. So resale values don't count as part of GDP. Goods that are produced in the current period but are not put on sale, for example, kept in inventories for final sale later on, they are valued at cost, whatever the firm paid to get these products produced. Once the product is sold out of inventory, then the cost of producing and putting it in the inventory is subtracted from the sale value, and the difference is considered the contribution of inventory activities to the production in the period in which the product is sold. Another aspect of the definition of GDP is the emphasis on market value. All the goods and services included in GDP are valued at market prices. Goods that are not transacted in the market are generally not included in GDP. Let me give you an example. If you go to a restaurant and have a dinner there, let's say it costs you $30, that's a transaction in the market, and that activity is recorded as part of GDP. Now, alternatively, what you could do is to buy the ingredients of that meal and cook it at home and enjoy it there. In that case, only those ingredients you've purchased in the market are going to be included in GDP, not your labor and time that went into preparation of the food. The reason for this differentiation between the two meals although in the end they may be very similar, is that in one case you've paid in the market and it's very clear how much you valued that meal and how much you've paid. But if you make the food at home and consume it there, there's no way that the government or any statistician can measure the value of the meal that you've consumed. You may like your own cooking, you may not like it. It's very difficult to tell, and therefore we don't have any easy way of measuring the value of goods and services produced at home. We don't include those kinds of activities in the GDP. Accuracy is very important for the measurement, so we know what we've measured, and then if we want to modify it, we want to make guesses of how much value is produced at home, we can do the additional work and find out those values. But it's very important to make sure that we have the number for the transactions in the market that we can measure. As it turns out, the market activity is usually associated with improvements in standard of living, so we're not missing too much by not including non-market activities in the GDP. However, we should be very conscious that across countries, the percentage of market activity versus non-market activity is very different. In developed countries, people tend to use the market for meeting their needs. For example, buying goods and services that they could potentially produce at home, but they prefer to buy it in the market, and they can do that. In developing countries, there's often a tendency to produce more goods and services at home and not engage in market activity. For example, in developing countries, it's much more common to make dinners at home or make one's own clothes. And this has an impact on the numbers that we get for GDP of developed and developing countries. Part of the difference is to the fact that there's less market activity in developing countries. It doesn't mean that they're necessarily that much poorer. However, when we look at the rankings, countries with higher GDP tend to have higher levels of income, higher overall welfare. There are some exceptions. There are some goods or services that are not sold in the market, they're non-market activities, and still they're included in GDP. A very prominent example is the rental of owner-occupied houses. People who live in their own houses, they don't pay rents. Rent is returned to a service, housing service. If you rent a place and you pay the rent monthly, you're getting a service and you're paying for it, that's included in GDP. People who live in their own houses don't pay that, but still we can measure how much they would have paid if they had rented the place. That's because the governments have very accurate information normally about the details of every house, every building, and implicitly they can calculate what the rent would have been if those houses had been rented rather than being owner-occupied. For that reason, because the accuracy is relatively high, statistical bureaus include owner-occupied house rentals in GDP calculations. The principles that apply to this calculation are similar to those that apply to taxation. If you can't measure it, it's hard to tax it. Now, before going any further on the definition of GDP and discussions about it, let me explain why, as I mentioned earlier, income is the same as expenditure in any economy. In order to do this, let me start by building the foundations of a model that we will be using in this course to understand how the macroeconomy works. Central to any economy's performance is how goods and services are produced in the market. The producers we call firms, and I'm going to put all of them together as one unit. The goods and services are produced are for the sake of consumption and benefit of the households, and goods and services flow from firms to the households. Households, of course, have to pay for this, so the payments flow back from households to firms. Firms produce goods and services using factors of production. That's labor, capital, buildings. Factors are ultimately owned by households. Labor, capital, someone owns them, somebody provides them. These are under the control of households. Households sell these services to to firms, and firms in exchange pay households in the form of income. That could be wage, that could be profit, that could be rental. So now, looking at this simple model of the economy, now you might say that there's so much more detail in the economy. For example, there's a government, there's the rest of the world, etc. I'm abstracting from all that, and I'm assuming they're all part of the households. Or you can ignore them for now, and I'm going to later on introduce those other elements into the economy, and you're going to see the result is the same. For this simple economy, it's very clear why income and expenditure are equal to each other. Any dollar that households spend on goods and services goes to firms. Firms then have to buy factor services in order to produce it. Notice that we're putting all the firms together, so all the intermediate flows from one firm to another is included within the firm's category. So ultimately, what comes out of the firms altogether is the purchases of labor and capital and services of buildings, etc., that ultimately all that money goes to the households. The next topic that I'm going to focus on is the issue of final goods and services, which was part of the definition of GDP. First, let me define what final goods and services are, and then see why we focus on that. In order to define final goods and services, actually we first have to understand what intermediate use of goods and services are. Any good or service that is not put into intermediate use is called final good. What's the intermediate use of goods and services? Intermediate goods and services are those that are used in the production process during the same period. For example, if tires are produced this period and then put on cars and the cars are sold, tire is an intermediate good. The car sold to the household, not used in the production process, is considered the final good. The reason we focus on final goods and services is that they include all the intermediate good values. So the value, the price of the final good consists of all the labor, capital, intermediate goods that has gone into the production process. If we want to include intermediate good prices and values in the calculation of GDP, we might be double counting. So to avoid that, we just focus on the final goods. Intermediate goods are not ignored. They're just included in the final good. Let me give you an example here. Suppose that rather than having all the firms together in the model I just developed, we have two types of firms. Let's say in this very simple economy, we're producing bread and flour. The household is buying bread from the baker, let's say $150 expenditure on bread. And in order to produce bread, the baker needs flour. Let's say the baker is spending $50 on flour in order to make bread. Note that the baker is making only $100, and that money, some of it is going to be wages, which is going to be labor services owned by the households. But there's going to be some profits or return to capital. That also goes to the households. Eventually, the $100 in one form or another is going to end up in the hands of the household. On the other side of the economy, the miller that produces flour might be also selling some of the flour directly to the households, let's say for making cookies. So this is going to be final expenditure. $20 household purchases of flour goes directly to the households and is not put into any production process that is then resold in the market. So the miller now is going to be earning $70, $50 from the baker, $20 from the households, and that money is going to be paying for wages or return to capital. Again, $70 is going to go to the households. Now, with the knowledge you have about the definition of GDP, what's your estimate of GDP of this economy? Is it 150, is it 170, 220, or 270? Take a moment to think about this. Well, I hope you chose 170, option B. That's the GDP of this economy. That's the value of all final goods and services sold in this economy. note that there was $150 intermediate expenditure in the economy, but that's already included in the value of the bread. We're not ignoring the intermediate good, we're just already taking into account the fact that it's already included in the value of final goods. Of course, one could calculate GDP by measuring value added. The value added of the miller is $70 because it's taking labor and capital services and turning it into goods and services worth $50 intermediate form, $20 final form. So that's $70. And the baker is producing $100 value added, which is the same as income that the baker passes on to the households. Altogether, that's again going to be income of the economy and equal to 170. That's another way of calculating the GDP, but it's easier to focus on the definition that says GDP is the value of all final goods and services produced in the economy. Finally, the definition emphasized the goods and services produced in a country. So the question is, why the emphasis on country? One might say, why don't we focus on incomes of nationals of a country? In fact, there is a measure called gross national product, which includes the total incomes of nationals of a country and excludes the incomes of foreigners working in that country. But this measure has some flaws. Number one is that it's very difficult to measure the gross national product of a country because there are a lot of nationals of the country working in other countries, and we may not be able to measure their incomes. Another shortcoming is that it may be actually quite misleading. For example, let's say the government of a country sets bad policies and the conditions deteriorate and the workers in that economy have to leave in order to work in another country and earn a living and send some money back home in the form of remittances to take care of their families. If you measure the GNP of this economy, it may be going up. As people who are poor leave the country, find jobs with higher pays in other countries, if you measure their incomes, it suddenly looks like their incomes have gone up. While in fact, they left the country because the conditions were bad. So the fact that GNP went up could be a sign that things are getting worse rather than getting better. GDP focuses on what's happening inside the borders of a country, regardless of whether the money is earned by foreigners or nationals. The GDP measure is a much better indicator of what the policies are doing, what's happening inside the country, and a way of understanding what the standard of living inside the country is.